Okay, thank you everyone for attending this evening. In light of budget changes, we've obviously had to continue on with our web series along in the new world under the new rules. And we're starting off with looking at how we can invest in property still using SMSFs and the various scenarios over which or within which people can use their super to buy a property. So we briefly discussed the unit trust strategy 3 weeks ago, I think, nearly now. Tonight, we're talking about the client that you talk to or the investor who has a substantial amount in super, maybe a couple that's 500,000 plus, and they're able to just buy direct property in super. This is the easiest, simplest, cheapest structure they can undertake. It's low risk, and there's certainly no compliance or ATO issues with it. So broadly speaking, with the legislative changes, it has no impact on this whatsoever because no LRBA is required. Because of that, you can effectively buy whatever property you want. There's a few rules around it, but as far as negative gearing goes, if you are buying solely in super, it's probably more of a lesser a consideration from the perspective of you're only in a 15% tax rate anyway. So you almost in a legal tax haven, as I sometimes refer to it as. So in a zero debt structure, no limited recourse borrowing arrangement is required. Because of that, there is no restriction on the property that can be purchased by the SMSF. So it can still go out and buy an existing residential property in an established area and rent it out of the super fund at commercial rates. That's fine. There's no restriction on that. With the ATO guidelines around that, broadly speaking, you would probably want 500,000 plus in super. That said, there are situations where people would like to invest in commercial units. We have a client, he has a side hustle in the furniture industry, and he wanted to buy an industrial unit close to Newcastle. So he got a 80 square metre unit, paid 220 grand for it, bought it outright in his super fund. Because it's commercial, he's able to lease it from his super fund and use it for his side hustle. So, it can be a really effective structure that ticks a lot of boxes for people. There's also a market panic around residential property and super generally. For those clients that have got sufficient money in super, they are basically unaffected by this. Christian, if we could have the next slide, please. So, under the new landscape, using the example of someone that has 500,000 plus in super, they're not using an LRBA. They basically have all the options that have always been open to them. So what people may be concerned about is the restrictions that the budget's put on them, that's put on super. That only applies if you're using borrowing within the fund. If borrowing within the fund is not utilised, then there is none of the restrictions from the budget apply in any way. So who it affects is basically people with larger super balances that aren't looking to gear up in their super fund. They might be closer to retirement, or they may just simply be risk averse. We're finding people at a younger and younger age have got account balances of 300,000 and 400,000 plus, thanks to 12% super. And so those people are looking at the industry funds or their retail master trusts, and they're wanting to exert some control over it. They may have parents that have been successful property investors, and so they would like to emulate that. And so they naturally want to roll their superannuation into a structure whereby they can exert control over it. By doing that in an SMSF, if there's sufficient funds in there, they can then go out and pay cash for a property. Other ways this can be done, if each of them has less than $500,000 in super and maybe they want to do a cash out of another asset and put that into super, particularly if they're getting close to 60, they can effectively utilize their carried forward concessional contributions, make a large contribution into super, claim a tax deduction for it, maybe offsetting gains from the sale of another property. There's a lot of opportunities to help people from a tax and investment perspective simply using super as a structure to hold your property. The silver lining is cash ready buyers are now the most powerful buyers in the SMSF market. If you rock up going to an auction, you've got $500,000 or $600,000 in your super fund. You don't have to consult with anybody. As long as that fund's got the cash, it can be transferred to a solicitor's account with ease. It's a lay down misère. Tristan, can we get the thank you. Okay, so to be clear, we're talking about having no bank debt over the property whatsoever. So quite simply, it's purchased in the name of the super fund. Super fund owns it. Super fund rents it out. Everything's paid by the fund. The rent goes into the fund, and it's just simply a illiquid investment by the fund at the discretion of the members. So from a buyer's agent's perspective, what we want to be able to do is first and foremost confirm that the fund will have sufficient liquid assets. So once again, feasibility, albeit in this situation, is pretty straightforward. So if we're dealing with people that don't have their SMSF set up, we're at 10th Avenue happy for them to send us through their latest member statements. We'll look at what the planning opportunities for them are with additional contributions, tax deductions and that kind of thing that they can make in order to bolster their superannuation balance and get into a more expensive property. So you guys can then go out and set the strategy. So when we're talking about a target asset in this situation, we no longer have to be concerned with a brand new residential property. It can be effectively any residential property. It can be commercial, it can be industrial. It just has to be done on what's referred to as an arm's length basis. What that means is they can't buy a residential property off themselves. It has to be bought off an unrelated third party, so preferably through an agent, and can't be off a family member or anyone else like that for residential. They also can't rent a residential property out to themselves or to a related party or family member, which gets us circling back to commercial or industrial property, where they can buy it from themselves, they can rent it out to themselves or a family member, and they can either, even at some point in the future, if they so desire, sell it to themselves. The third party or arm's length provisions only relate to residential property specifically. Once we've set our strategy, we've identified the property, we know what we're going to proceed with. The SMSF simply purchases it in its name. It is the owner. There's no bare trust or custodian deed. It's clean title, it's minimal structure, and they have absolute control over it. There's also highly unlikely to be any legislative change that will impact on it moving forward into the future, which is another important distinction. Tristan, can we have the next slide, please? So, structuring the direct purchase, there's no bare trust required, so we don't have to be concerned with the differences in when and how the bare trusts are signed for the different states. So that's That's a great thing. It's clean title. So when you're getting your contracts done dealing with your conveyances, just simply give them the front page of the SMSF deed and the certificate of the certificate of registration of the corporate trustee if there is one. And that's it. That's the name that it all goes in. Contracts are easier. It's really a really pleasant structure to deal with. The setup costs for the fund are greatly reduced. We don't need an bear trust. We don't need a trustee for the bear trust. We can also set up the fund with individual trustees, so there's no need for a corporate trustee at all. My advice to anyone would be to, particularly where there's two members, always set it up with a corporate trustee. It's more flexible over time. If you have a single member fund, it has to have a corporate trustee. There's no choice. But, if there are two members, they do have the choice of setting up the SMSF without a corporate trustee. So there's a significant saving there. The effect of it all is, before age 60, the rent that the fund earns on the asset is taxed at 15%. If it was in your name, personally, it'd be taxed at your highest marginal rate. So this is particularly beneficial for high income tax earners. Also, before age 60, if the property is sold, the effective tax rate on the gain is 10%. Now, the way that works is technically it's 2/3 of the tax rate of super, which is 15%, 2/3 of which being 10, so 10%. Importantly, though, if we're buying real estate assets, we're in our early 50s, we're going to hold them for 10 years. Once we turn 60, we want to start transition to retirement pensions straight away. Then our net rent becomes 100% tax-free because the tax rate on pension assets is 0. We can also, after age 60, sell that asset and, irrespective of the amount of gain, pay no tax at all on the capital gain. So there is no minimum 30% tax on the gain inside super after age 60. And that is a very critical point. If we've got people that are cashed up, they don't want the stress of being in liquid assets that are in shares and managed funds, and they want to exert some control over their super, they are able to avoid the minimum 30% tax on capital gains completely. That will be highly attractive to many business owners, particularly buying their business premises in self-managed super. So that's a really powerful planning tool. Tristan, could we have the next slide, please? Thank you. So we've still got to be mindful of the ATO, as always. So the property's got to meet the sole purpose test, which is effectively it needs to be for retirement income. If it's residential, you can't rent it yourself, you can't buy it off yourself, and you can't do either of those. You can't do either of those things with a family member or close associate. Can't be a lifestyle asset either. Commercial property, however, is a lot different. So you can buy a commercial property in a self-managed fund from yourself, and you can rent it back off your super fund for your own business or side hustle. It just has to be done at commercial rates. I do want to stress that the commercial rate distinction, all super funds have to be independently audited every year. So where we have a commercial property where a related party is the tenant, we do have to prove each year that those rents are at a commercial rate. They are market rates. It's pretty straightforward. We just get a letter from a local real estate agent. They're usually pretty happy to do it. But it does need to be realistic. It can't be, hypothetically, if you're buying a $600,000 industrial unit off yourself and you pay $100,000 for it, that will get trapped and cause a problem. And the rents are the same. If you massively inflate or deflate the rents, that will get captured as well. Additional funds will need to either be put into the fund or reimbursed, etc. Once again, so that basically, yeah. So that's the arm's length transaction issue. Things that have got to be done at an arm's length with residential or at commercial rates for commercial and industrial property. Related party acquisitions, once again, residential property is just a no-go zone, but industrial and commercial are fine as long as they're at market rates. The assets that sit inside an SMSF, if they are property, do have to be regularly valued. So that has traditionally been every 2 years. We go out to 1 or 2 local real estate agents usually, and we'll get a market appraisal, send that off to the auditor, and usually they're pretty happy with that. If people want more of an independent valuation, there are a number of firms now that specifically do property valuation, desktop property valuations for SMSFs. They're usually pretty cost effective. They're sort of $300 or $400. But yeah, that's the situation around those. Tristan? Okay, so using this, there's a logical shift in power from the purchaser's perspective. So when you've got a limited amount of super and you're relying on an LRBA, which is still available to commercial and industrial property, which I think is important to mention, you're very much at the behest of the lenders. How much will they lend? What's the LVR? Complexity around declaring income, particularly if you're self-employed, and the costs with getting those loans. There's a cost there. As we said, commercial is available through an LRBA that has the same issue, except that it still continues. An LRBA in residential property after about the 10th of August is just not going to be available. A cash-ready SMSF, however, has absolute power. It has the cash. It can go buy a property, transfer the funds required to a trust account tomorrow, and it effectively owns it. So it's a very fast transaction, and usually one that's pretty low stress for all parties concerned. So, someone is cashed up, they're looking for a low stress option. That is certainly something to give due consideration towards. Can we have the next slide, please, Tristan? Okay, so post legislation, there is a window where we can continue to use LRBA for residential property. That's going to close on somewhere around the 10th to the 17th of August. It's probably going to be dictated more by when lenders will close their books more so than anything else. So we do be mindful of that in the next 3 weeks. So there is a lot of confusion out there still. I think everyone's well aware, particularly in the residential property market, the decline in auction clearance rates. So potentially for a cashed up fund, there is the opportunity to buy property that was potentially too expensive for it. Those prices are likely to come down over the next 6 months. We basically have a tactical opportunity for people with sufficient amounts in super. They don't need finance approval. They don't have to open LRBAs. There's no valuations. Basically, they just go out and buy a property at their own discretion. Tristan, can we have the last slide, please? So, first and foremost, we want to assess the situation, do the feasibility. We still want to see those super statements so we know exactly what we're dealing with. So if a client comes to me and says, I've got 620K in super, we need to check that. They're a sole trader, they want a commercial property for their business, that's fine. As long as they can buy that property for less than 620 grand, they can do that whenever they choose. There's no other hurdles to pass. There's nothing else to open, no special trusts or anything else, they're there already. So here's another one. We were 6 weeks from settlement on a residential LRBA. What are the options now, and is there any grandfathering? So as long as there is an exchange of contract on the residential property and the lender is supportive of it, the LRBA can still complete. After about the 10th to the 17th of August, that's a bit of a grey period. After the 17th of August, it's just going to be a hard pass. Residential property with an LRBA just won't be available. Minimum balance is always an interesting question here. So technically, on ASIC, you shouldn't open an SMSF with less than 250 grand. You're paying cash for a property, that's not going to buy much. That said, you can get some pretty good quality industrial units for 200 to 250,000 in regional areas. So it's certainly, that's a consideration. I mean, you can even get them for cheaper than that. It would depend on what strategy the client wants to undertake, what their goals are, and, what is the available, what's available for you guys to find at those goals and that strategy at a given price. So if a client wants to buy a property of a family member at below market value, that's just not going to work. Okay, we've got to, in that situation, it couldn't be residential to start with. That's a hard pass. If it was commercial or industrial, there would need to be an independent valuation if you're doing that off a family member. An auditor just won't let that go through. So in that case, absolutely, you can do it if it's commercial or industrial. Residential is a hard pass. You just need to do it at market rates. So, do an assessment with one or two local real estate agents, get a handle on what it's worth so that you've got a third party that's determining its value, not yourselves. And as long as you tick all those, everything's fine. I would just suggest probably contacting us for a strategy session for your clients. As I said, there are substantial planning opportunities that we can undertake where people are putting money into super to bolster their account balance to undertake their purchases.
Are you there, Brendan? We're getting some echo, mate.
Sorry, my apologies.
There we go. Okay. Well, that's all I've got to say. If we've got any questions. Or we've been too thorough as always. This is a pretty straightforward strategy. We're basically dealing with a person or couple that have got sufficient assets in super to buy the investment asset they want in their fund without the purposes of borrowing. It's a straightforward, easy process. It's pretty good. Yeah. So can understand if there's no questions. Probably in the absence of questions, I'd just say some of the planning opportunities you've got, if clients have less than 500 grand in super and haven't been maximizing their contributions over the last 5 years, they will have quite often a substantial amount of carried forward contributions that they can make to go into super. That is a tax deduction. So if they've got cash outside super or they're willing to borrow against other assets to bolster the fund, they are able to create a tax deduction by that contribution. So usually we use this where if someone's disposing of a property, they've got a capital gains issue. If they've got less than 500 grand, the first thing we want to do in planning what the tax liability on that will be is look at what their carried forward contribution cap is. So we will want to maximize that because that will directly reduce the capital gain liability on the property they're disposing of and bolster their super. And that could well be the catalyst for the next purchase, next property purchase inside their SMSF. So that's probably the easiest one to look at. There's a few others, but As always, we're happy to do a feasibility study, give a few planning pointers to people at no cost, just to make sure that these purchases go through and everything ticks the boxes for the ATO.
Matt, question: how sharp do you think that 10th of August, or say close of business 9th of August, would be in terms of lenders being willing to extend a pre-approval? And also, would that be the cutoff, or would it more be that they have to have actually exchanged contracts prior to that 9th or 10th of August?
Yeah, at the moment, they really are going to have to exchange by the 10th.
Right.
That's the indication. So I've been taking my guidance on that from lenders. They're the ones stumping up the money. So that's our most effective source of information, because they've got the most skin in the game. Is the best option I can give you. If I were you guys, you've got clients that want to undertake an LRBA in residential property before the cutoff date, I would be doing everything I could do to get an exchange by the 10th.
Yeah. Okay. Yeah. That matches my
beyond that, it's going to be a maybe.
Yeah. So possibly as far as the 17th of August, but that might only be some lenders.
You're taking a risk that it won't get across the line after that.
Yeah.
Maybe it will, maybe it won't. I wouldn't like to tell anyone that it's a definite, because I don't think it is.